Welcome, accounting boffins. You with Ashraf Patel and the crew. What are we doing today? Today we're looking at balance sheets, also known as the statement of financial position. So therefore, if you're looking at the balance sheet, remember, your components of your balance sheet, you would have your assets, you would have your equity, and you would have your liabilities, right? Remember that this is drawn up at the end of your year, namely your financial year end. Remember, your adjustment impacts on both your income statement, also known as your statement of comprehensive income, and as well on your balance sheet, which we call our statement of financial position. So in other words, what am I referring to here is the format of the balance sheet. It is of extreme importance that you know the formats, you know what goes into the respective components of the balance sheet, and that is something that once you know, and when you do your activities or past papers, you will find it easier to complete your statement of financial positions. Now, I'm not referring to the actual adjustments and the calculations here. I'm referring to the basic format of your statement of financial position. Please, guys, ensure that you know it. You are not certain whether your answer book will have pre-populated certain details for you. So rather, you know it when you go into the exam room. If it's pre-populated, well and good. If not, you know what goes into which section of your balance sheet. Okay. We start off with an appetizer, which says here, indicate whether the following statement is true or false, right? A fixed deposit maturing within 12 months will be shown as cash and cash equivalents in the balance sheet. Right. Before we actually come to the answer, let me first do an explanation on it. A fixed deposit, by definition, has a maturation period of greater than 12 months. Therefore, it appears as a financial asset in my balance sheet. So my assets would be my non-current assets, financial assets, and then my current assets. Remember I spoke about the format? Now, we're dealing specifically with the fixed deposit. Any portion or any fixed deposit that is maturing within 12 months no longer fits the description of a fixed deposit, and therefore it has to appear under my cash and cash equivalents. Coming back to my statement, a fixed deposit maturing within the next 12 months, yes, will be shown as cash and cash equivalents. Obviously, your answer here is true. Right? Why? Because that fixed deposit that matures within 12 months is no longer a financial asset, but rather a cash and cash equivalent. What else does this mean? It means that within 12 months, you will have access to that cash. So, you are giving important information to the reader of the statement of financial position. Next one. Net current assets are also referred to as the net working capital, right? What do you understand by the term net current assets? Net current assets is current assets minus your current liabilities. And yes, it's also referred to as your working capital. So therefore, net current assets, yes, indeed, it refers to your net working capital. So once again, my answer here is true. Next one. Indicate whether the following statement is true or false. Provision for bad debts is a liability. We know that provision for bad debts has a credit balance. True. But is it a liability? And the answer is an emphatic no. What do I mean by that? By that I mean provision for bad debts is what we refer to as a negative asset. Why? It reduces the value of your asset. Which asset? Debtors control, less provision for bad debts gives you net trade debtors. So it is not a liability. Therefore, this statement would be false. Okay, next one. Indicate, we'll be busy with true and false. Total capital employed consists only of capital and the current accounts. If you're dealing with a partnership, then think about it. Capital employed is not only equity, but it also includes your non-current liability. So keep that in mind. Capital employed is both equity plus non-current liabilities. Therefore, this statement would be false because we know it also includes the non-current liability component of your balance sheet. Okay, here we have information from the books of Queen Stores for the financial year end 30th of June 2020. An allowance of 240 Rand granted to a debtor, A. Abdul, for damaged goods sold to him must still be recorded. Okay, now, whenever it comes to an allowance to a debtor, remember I said, and I'm saying it again, two parts to the transaction. Firstly, if there was a physical return of goods, then you need to do two adjustments. One would be debtors allowances and debtors control, and the second one would be cost of sales and trading stock. Reason, the goods are coming back to us. There's a physical return of goods. The first part of the entry, the debtors allowances and the debtors control, would be your selling price, and the cost of sales and the trading stock would be the cost price. This particular transaction just says an allowance of 240 Rand granted to the debtor. No physical return, only an allowance. Watch, this is what we do. So, in my debtors control, you start off with your given figure minus the 240 will give you your debtors control figure of 36,180. Obviously, you took the 36,420 minus the 240. Okay, then we were told that the provision for bad debts must be adjusted to 5% of your debtors control after taking into consideration the above. Watch this calculation. So obviously, you first took your 36,420. Let's do that. 36,420 minus the 240 gave you a figure of 36,180, which we have there. There's the 36,180. Okay, now take the 36,180 times your 5%, and you get a figure of 1809. Okay, now what do? I have an existing provision of 2195, right? My new provision is 1809. Clearly you can see from this here, clearly you can see that your provision must be decreased, right? Let's look at the impact on the balance sheet. Here we go. When we've done our calculation, now we know that in my balance sheet, you're going to have debtors control as 36180, right? So 36180 less your provision for bad debts now of 1809. Okay, let's do that. We've got 36180 minus 1809 will give me a figure of 34371. So 34371 is your net trade debtors. Clear? So you can see now that when you're drawing up your balance sheet, take into consideration your new provision, right? While we're at it, let's just look at this part here. If my old provision was 2195, which it was, right? So we got 2195, and the new provision is minus 1809. That gave you a figure of 386. What will you do? Where will the 386 be recorded? Or, in other words, what do you do with the 386? Remember, that goes to your statement of comprehensive income, your 386, because you are decreasing your provision for bad debts. You're going to say debit provision for bad debts, credit provision for bad debts adjustment with the amount of 386, which then becomes an income because you have decreased your provision for bad debts. We also remember that when you increase your provision for bad debts, your adjustment account will be an operating expense. Okay, it says here, advertisement expenses include 735 for a 3-month contract with a daily dispatch, which commenced on the 1st of June 2020. Right, our calculation is simple. Take your 735, right? 735 divided by 3, right? And then obviously 2 months falling out of our period times 2 will give me a figure of 490. Right, so I've identified my calculation as 490. Now remember, this is a prepaid expense, right? Where does it feature in my balance sheet? It appears under trade and other receivables. Okay, so here you see now. There's our debtors control. We started off with the 36420 minus the 240, which was the allowance, to give me a figure of 36,180, right? There's my provision, remember, the 2195 minus the 386. We spoke at length about the 386 to give me my new provision of 1809. Obviously, we would, after these two figures, we would have a net trade debtors. Then you bring in your prepaid expenses. Okay, and under prepaid expenses would be all the expenses that we have adjusted. In this case here, it was the advertising one. We had prepaid an amount of 490 Rand. Okay, what else would appear under my prepaid expenses in my trade and other receivables? Think about it. Accrued income would be one, right? Deposit on water and electricity, right? You would also have SARS, obviously. If your PAYE has a debit balance for whatever reason, there may be an error in calculations or whatever. So that could also appear. And the last item that could appear there would be your insurance claim. We've dealt with this in our previous lessons, where the insurance company have accepted our claim, but they haven't paid us as yet. That insurance claim will feature under trade and other receivables. Okay. According to a physical stock take on the 30th of June, the stock on hand was as follows. Your trading stock was 45,650. Compare it to what appears in your trial balance. Trading stock 50,555. Immediately you can see that that was the figure we were supposed to have, and because we only have 45,650 as our final figure, there has to be a trading stock deficit of 4905. In other words, your physical stock take is the correct figure, and that's the figure that needs to appear in my balance sheet. The figure that appears in my trial balance, obviously there has been some kind of deficit of stock, as a result of which we say debit trading stock deficit, credit the trading stock, and that's the entry, and as a result of which our trading stock is now 45,650. Remember, consumable stores on hand, that will be the items that we have left over of consumables that have not been utilized, and that falls under inventory. And the reason it falls under inventory is because it tells you, according to a physical stock take, therefore, you can see your consumable stores is 720. Okay, what have we done in this segment? We've done a few adjustments and we've shown you the impact of those adjustments on your balance sheet, right? Because remember, like I alluded to earlier on, know the format of your balance sheet so you will know where to place certain items. You want to know more about the balance sheet? Stay with Ashraf and the crew. We'll see you just now. Welcome back, accounting boffins, right? Remember, we're busy with the balance sheet, also known as the statement of financial position, and we're looking at the adjustments and how they impact on the statement of financial position. So remember, when you are doing your adjustments, right? When you are doing your adjustments, these adjustments are impacting on your balance sheet. They're also impacting on your income statement, right? Again, we said, remember the components of your balance sheet. You have your assets. Under assets, you have your three components, namely your non-current assets, you have your financial asset, and then obviously you have your current assets. Okay, so this means therefore that the format of your balance sheet is critical when you are attempting a question on the statement of financial position, namely the balance sheet. Okay, so here we go. The following information appeared in the June bank statement. These must still be taken into account. There's bank charges of 350, interest is debited of 220. There's a direct deposit for the June 2020 rent from M. Moses. The rent was increased by 200 Rand per month from the 1st of April 2020. Okay, now, in terms of my calculations, firstly, I'm given a rent income figure of 35,600. Okay, that's my rental figure that's given to me. There's a direct deposit that I need to take into consideration. And I was told there was an increase in the rental of 200 Rand per month. Let's just verify that information. The rent was increased by 200 Rand per month from the 1st of April 2020. So this is what I do. Step number one, start off with your 35,600, right? And remember, you know that the rent was increased from the 1st of April. So April and May, those 2 months, the increased rental works out to 400 Rand. Got it? Okay? So what do I now do? I now say, fine, take my 35,600 minus the increase of 400, which will give me a figure of 35,200. What am I doing? I'm trying to ascertain what figure should be used as my rent figure, because they only told me that the rent, there was a direct deposit from our tenant, and they told me that the rent was increased by 200 Rand from the 1st of April. So step number one, remove the increase. For how many months? April and May. So 200 Rand per month times 2 will give you the 400. So that's the reason I'm subtracting the 400 to give me my figure of 35,200. Okay, now take that 35,200 and divide it by 11. Why 11? Because you've received rental right up to May. It's the June one that appears as a direct deposit. Okay, let's do that calculation. So here we go. We had 35,600 minus the 400, which was the increase for the 2 months, to give me 35,200. Divide the 35,200 by 11 to give me the rental of 3,200. So this was the rental prior, before the increase. Okay, guys? It was the before the increase. Clear? Now, if that was my amount before the increase, what do I now do? So I've got the figure before the increase. I now add the increase to that amount. Here we go. Take your 3,200, which we've calculated there, plus the 200 increase, meaning that your new rental will therefore be 3,400. That will be the new rental after the increase. Okay, so you can clearly see that you had to calculate what your rental figure was based on the information that was given to you. Okay, so now that we have that figure, let us see how is this going to impact on my balance sheet. Okay, we've got bank charges of 350. We've got that figure. We've got the interest of 220, and we've worked out our direct deposit to be 3,400. Okay, so there's my 3,400 was the direct deposit. Here we go. Your bank figure, obviously you started off with the 5,440, which was my given figure. So here we have the 5,440 as my starting, minus the 350, what was that? My bank charges, minus my interest on overdraft. Okay, now just a bit of information on that one there, on the interest on overdraft. Here it was called the interest that was debited, which is actually your interest on overdraft. Now, bank charges and interest on overdraft are both charges levied by the bank. However, in accounting, and for good reasons, we always keep bank charges as an operating expense and the interest expense as a separate item, because interest expense is not an operating expense. Rather, it is a financing expense, and therefore, notice even in your income statement, it appears as a separate item at the bottom of your statement of comprehensive income. Clear? I hope that is crystal clear to you. So keep your bank charges separate from your interest on overdraft. Okay, but obviously for calculation purposes, all of them are decreasing your bank figure. Therefore, we say 5,440, which was my starting figure, minus the bank charge, minus the interest on overdraft, and plus the 3,400. Clearly you can see that that was your rent amount that was directly deposited into your bank account. So obviously it's going to increase your bank account. So if we take all of that into consideration now, you start off with 5,440 minus 350 minus 220 plus 3,400, and that gives me my new bank figure of 8,270. Okay. What else goes into this note, namely your cash and cash equivalents? It will be your bank, which you've seen there, plus your petty cash, plus your cash float, and another very important figure is what? The fixed deposit. Which one? The fixed deposit. The one maturing within 12 months. Remember, the one that's going to mature within 12 months will be taken out of my fixed deposit under financial assets and will be added to my cash and cash equivalents. So keep this in mind. Whenever you're doing a balance sheet, look for the financial asset, namely the fixed deposit. See which component is maturing within 12 months. Take it out of the fixed deposit and include it into your cash and cash equivalents. Right, next one. Wherever interest on the mortgage loan is capitalized, let me explain that to you. When they say interest is being capitalized, what does it mean? It means that the interest that is accrued on the loan is added back to the loan. That's what we mean that interest is capitalized. Okay. The loan statement received from Flow Bank gave the following. Your balance at the beginning was 300,000. Your total repayments, including the interest, was 129,000, and your balance at the end was 198,450. Okay, now, like I always say, whenever you have this information, put it in the form of a T account. It will make it much clearer and easier for you to understand. Let's do that. Okay, here we go. There's my opening balance of 300,000. Right? Opening balance. There's my bank figure, repayments including my interest. There's my balance at the end of the year. Right. Firstly, let me do my calculation. So we say 198,450 plus 129,000 is equal to that, minus the 300,000, which is your opening balance of your loan, right? Will give you a figure, a missing figure of 27,450. Here we go. There's your 27,450 as your interest that has been capitalized. Right. What do you need the 27,450 Rand for? The 27,450 Rand will go to your statement of comprehensive income. Under the bottom section, you'll say there, interest expense. How much? 27,450. Right. We're now in the balance sheet. How do we report in our balance sheet? Very, very important. Look at this last statement here. The capital repayment will remain the same as last year, right? So information, the capital repayment will stay the same. Okay. So this is what we do. You take your 198,450, which is your closing balance. Watch, it's your closing balance, 198,450. Right, now, if you look at your bank payment, you've paid a total of 129,000. Okay, 129,000 was the total amount that you've paid. But included in there was interest of 27,450. So minus 27,450, and this gives you a figure of 101,550. I'm just going to write it here, 101,550. What was the 101,550? So you've paid the bank a total of 129,000. Clearly you can see it, right? Of that, you had interest to the value of 27,450. So therefore, if you subtract the interest, bank minus the interest, it gave you a figure of 101,550, meaning your capital repayment on the loan was 101,550. But now, let me show you another way of checking this out. Okay, watch this. If I take my opening balance of 300,000, right? 300,000 minus my closing balance of 198,450, 198,450. What do you get? What do you get? 101,550, the same amount. So there's two ways of verifying the capital repayment. One, you compare your opening to your closing balance, right? If you have all the information. And number two, you could take your bank figure, your total payments, which has capital plus interest in it, minus your interest to give you your capital repayment. Therefore, now when it comes to my balance sheet, watch this here. It's a 198,450, which was my closing balance. Once again, there let's identify it so you can clearly see it. My closing balance of 198,450 minus the capital repayment. And I showed you how we got that figure. So obviously, it will be the 198,450 minus 101,450. And there you have your figure of 97,000 Rand, which is your current liability. Right. Now, the moment you subtract that from your non-current liability, so in other words, your non-current liability is your loan that has a repayment period of greater than 12 months. The short-term loan must be taken out, and that's exactly what we are doing. We're removing the short-term loan from our non-current liability. How much are we removing? 101,450. And what are we doing to it? We're replacing it under current liabilities short-term loan, namely 101,450. What are you doing here? You're explaining to the reader of the balance sheet that yes, we've got a non-current liability. The amount is 198,450, but in next year, within 12 months, you'll have to make a repayment of 101,450. And that then moves from being your non-current liability to your short-term loan. That means payable within 12 months. That's your current portion of your loan, also known as the short-term loan. Clear, guys? So whenever you're dealing with a loan, remember the separation. Separate your non-current liability from it, remove the short-term loan, that portion of the loan that's repayable within 12 months. Okay. So we've dealt with the bank charges, we've dealt with the interest, we've dealt with the direct deposit. Finally, we are told there's a fixed deposit of 100,000. 30% of the fixed deposit will mature within the next year. What are we going to do? Watch. Under my financial asset, I've got my fixed deposit of 100,000 minus the 30,000 that will mature. Therefore, my financial asset is now 70,000. Where do I place the 30,000? Under cash and cash equivalents. I say fixed deposit maturing within 12 months, and therefore I have that 30,000. Notice that whatever you subtract there has to be the same figure. So with the fixed deposit as well, what do? We remove the portion that's maturing within 12 months. We take it out of the financial asset and we place it where? Under cash and cash equivalents. Telling the reader of the balance sheet, within 12 months, you will have access to 30,000 Rand because it will mature and the funds will flow into my bank account and I will have access to it. Okay, guys, that's the second segment concluded. What have we done here? We've looked at specific adjustments pertaining to the balance sheet and how you must go about handling it. I'm sure we've piqued your interest and you now want to know more. Stay with us. We'll see you shortly. Welcome back, Accounting Boffins. You with Ashraf Patel. We're looking at the balance sheet. Remember what we said? The links, keep in mind that your adjustment will have an impact on what? It will impact on your income statement, right? And it's going to impact on the balance sheet. So, one aspect of the adjustment affects the income statement, the other affects the balance sheet. For examination purposes, you are expected to know both of them, how to complete both the statement of comprehensive income as well as the statement of financial position. In other words, income statement, balance sheet. Okay. Now remember, these are notes that you have to complete. The tangible asset note, the trade and other receivable note, your capital account note, your trade and other payables note, and obviously all of these then fit into your balance sheet. Okay? Now, these are not the only notes. Remember, there's also the cash and cash equivalents. There's your interest income, interest expense. There's your inventories. So all of those are important. We're going to highlight a few of them here. And the first one we're going to be looking at is your tangible asset note. What is important in this note is the following. One, these are your balances at the beginning of the year, right? So all of this will be your balances at the beginning of the year. Okay, what do you have there? You have the cost price, you've got your accumulated depreciation, cost price minus accumulated depreciation obviously gives me my carrying value. So this would apply to all your vehicles and equipment. Remembering that land and buildings does not have accumulated depreciation, right? We know that for a fact that land and buildings do not depreciate. Therefore, there's no accumulated depreciation for land and buildings, but obviously it's the accumulated depreciation is applicable to my vehicles and my equipment. Okay, then you have movements during the year. In other words, what happened? Did we buy more? There's your additions at cost. Did I dispose of during the year? The important part of the disposal, guys, in fact, in all our lessons, whenever we dealt with a question on asset disposal, we made it abundantly clear to you that you draw up your table, and in your table, you have an item that says disposals at carrying value. That item is what you need, or that figure is what you need to include when you are doing note number 3. There we go. Disposals at carrying value. Right. Then you bring in your depreciation for the year. With regards to depreciation, remember the 3 components of depreciation. What are they? The sold, the old unsold, and the new. Right? All 3 must be added together to give you your total depreciation for the year. Okay, now watch this. You got your carrying value at the beginning of the year, right? You add your additions at cost. You subtract. So let's take the arrow to the correct figure there. There you got you add your additions at cost. You subtract. Let's do that in a different color. You subtract your disposals at carrying value. You subtract your depreciation for the year, and that then gives you your carrying value at the end of the year. Right. Now, this is your check. You take your cost at the end of the year, subtract your accumulated depreciation at the end of the year, and that figure has to then correspond with, so working from top to bottom, your carrying value at the beginning of the year, plus your additions at cost, less your disposals at carrying value, less your depreciation will give you that figure which is your carrying value at the end of the year. So end of the year, cost price minus accumulated depreciation will then give you your carrying value at the end of the year. Those 2 figures, when you're working top to bottom and bottom up, has to agree. Okay. When you come to your trade and other receivables note, you start off with your trade debtors, which is your debtors control, less your provision for bad debts will give you net trade debtors. Then you bring in your income receivable or accrued income, your prepaid expenses, deposit on water and electricity, and your insurance claim. Right? So, let me just explain. A deposit on water and electricity is the deposit that you've paid the local council for using their services. The moment you stop using or you don't need their services, that deposit will be refunded to you. Obviously, for example, if you have a fixed telephone line with a service provider, you pay a deposit. The day you say, thank you very much, I don't need that service anymore, the deposit is refunded to you. Therefore, your deposits, whether it be for water and electricity or whatever else it may be for, is an asset, and therefore it appears under trade and other receivables. Insurance claim, we've alluded to this in many of our lessons, but a reminder is beneficial. Once again, insurance claim, that claim that you've lodged with the insurance company, they've accepted the claim, acknowledged it, but haven't paid you as yet. Therefore, that figure is part of your trade and other receivables because it indicates to you that they owe you that money. Clear? Well done. Next one. is your capital account. Obviously, it's your balance at the beginning of the year. Bring in your additions of capital, withdrawals of capital, right? Your drawings, and obviously, you've got to also take into consideration, this is your balance at the end of the year. The one component that you need to add here, obviously, would be the profit. You would add your profit that you've made, or you would subtract the loss if the business has made a loss. So these two components obviously will also impact on your capital account note, right? So what we have here is your balance at the beginning of the year, plus your contributions of capital, withdrawals of capital, bring in your profit or your loss, and then obviously your drawings. This will then give you your balance at the end of the year. Next note is your trade and other payables. Now, your trade and other payables note, also a very important note, and look at the information that needs to go into these notes. You need all your liabilities, your trade and other payables. Watch, it's your trade creditors, creditors control, your expenses payable or accrued expenses, right? Income received in advance, also known as deferred income, okay? Then you have all your liabilities in respect of salaries and wages. Remember, when you make your adjustment for salaries and wages, you're debiting the gross salary and you're crediting all your liabilities. Who do you owe that monies to? You owe it to, obviously, your employee, which is your creditors for salaries. You owe it to SARS, which is your PAYE. You may be owing the pension fund. You may be owing the medical aid fund. You may be owing the UIF fund. So those are all liabilities that you take into consideration. Remember, another item that could appear either on the face of the balance sheet or it could appear under your trade and other payables, right? What is that? That's your short-term loan. Remember we've spoken about it, where you take your non-current liability and split it up into two components, into the portion greater than 12 months, which is your non-current liability, and the amount payable within 12 months, which is your short-term loan. Right, so there's your short-term loan or your current portion of your loan, and this is an important one, very, very important one. If you have premises that you are leasing to your tenant, if that tenant has paid a deposit on that lease, right? Let's look at the entry. We're receiving money, so we debit bank. You credit deposit from tenant. It's a liability, guys. Why is it a liability? Because if the tenant's lease expires and the tenant now says, okay, I'm moving to another premises or I've bought my own premises, that deposit will have to be repaid to the tenant, and therefore it appears under trade and other payables. It is that portion that has to be repaid to your tenant because the deposit is an upfront payment, like we had a deposit of water and electricity, which is an asset to us. The deposit that we are keeping on behalf of a property that we have leased is, by the same token, a liability, and therefore appears under trade and other payables. Okay, so if you're looking at your balance sheet in its entirety now, right? You start off with your tangible assets, which comes from note number 3, right? You add your fixed deposit, which is your financial asset, right? And those two added together will give you that asset component there, right? And then you bring in your current assets, right? And then obviously these three figures, what are we talking about? The non-current assets plus your current assets will give you your total assets figure, right? Now, you also must know this, that your total assets figure, that means the top half of your balance sheet, has to be in agreement or has to be the same as the bottom half of your balance sheet. Watch this here. So, before we get there, let's look at our inventories, We've dealt with inventories, it's trading stock plus consumable stores. We've dealt with trade and other receivables, and we've dealt with our cash and cash equivalents. That then gives me my total assets. So what makes up my total assets? It will be my tangible assets plus my financial asset plus my current assets. Those three components will be the top half of my balance sheet, giving me total assets. Keep this in mind. We said this total assets figure has to be the same as my total equity and liabilities. Now, what is it that goes into my bottom half of my balance sheet in terms of the one, equity? Obviously, that's your capital. We've discussed that one there. Then you come to your non-current liability. Remember the loan. We said, what about the loan? This is the one payable over a period greater than 12 months, and that becomes your non-current liability. Okay. Then you bring in your current liabilities. What do you have under current liabilities? You have your trade and other payables. We've discussed this note at length. Now, obviously, you will notice here that if your short-term loan was not included in your trade and other payables, then it has to appear as a standalone item on the face of the balance sheet, right? So depending on the question, right, and what are the requirements of it, but the easiest way to remember it is to tell yourself, right, I have trade and other payables, one item, I have my short-term loan or my current portion of my loan, and very, very, very important is my bank overdraft. Right. So what type of an account is bank? The question is, what type of an account is bank? The answer is, it depends on what? On whether bank has a debit balance, favorable, or it has a credit balance, is in overdraft. Got that? So don't make any assumptions. Always check the status of your bank account, whether it is a favorable bank balance or whether it is in overdraft. Certainly, if it is a favorable bank balance, it will appear under cash and cash equivalents. But if it's not a favorable bank balance, if it's in overdraft, it will appear under my current liabilities on the face of my balance sheet as a bank overdraft. Okay, so there we go. I then add up my current liabilities to give me the total of my current liabilities. I now add my equity plus my non-current liability plus my current liability, so component 1, 2, and 3, right? So what is it? It's my equity, my non-current liabilities, and my current liabilities will then give me my total equity and liabilities. What do we know from the balance sheet? We know that our total equity and liabilities, this figure here, watch what I'm going to do here now. I'm saying that one has to be the same as my total assets. That means the top half of your balance sheet must agree with the bottom half of your balance sheet. Now, another important consideration here is sometimes you are given financial indicators to work out missing figures. Please, you must be able to do that. For example, if you are given a current ratio of 2:1, right? That means current assets is to current liabilities is 2:1. You could be asked to work out your current liabilities as a missing figure. So if you are given the current assets as 2, you know your current liabilities is 1, you can use that ratio to find out a missing figure. Keep that in mind. Very, very important for examination purposes. Okay, in conclusion, know how to deal with your fixed deposit. Know how to deal with your current liabilities. Note that your total fixed assets must be equal to your total equity and liabilities. Okay, guys? So, you can clearly see that once you start doing these activities, once you start engaging with your past papers, I promise you, you're going to start enjoying your accounting work. And once you start enjoying it, I promise you, you're going to ace it. 100% is definitely in reach. From Ashraf Patel and the team, definitely you're aiming for the moon, but whether you get there or not is not important. You'll definitely be an accounting shining star. In other words, you'll be to enable an accounting shining star. Until the next time, be good. Goodbye.